Alright, welcome back. We continue from the previous clip. So we can say that Alphabet had higher and more stable return on shareholders' investment. This is return on shareholders' investment refers to ROE, higher ROE. This is due to two things. One is because it has lower operating costs. The costs are lower, therefore they get better profit. And the second is that it uses assets more efficiently. It uses less assets, because the total asset turnover is higher, and it's also more stable. And the other reason is that, because they use less assets, it also means that it has less need for financing those assets. Less funds are needed, or less capital is needed. And because less capital is needed, so there's less financing. But if the company had used more debt to finance the assets, then the ROE would have been even higher. But because it uses less debt, then the ROE is slightly lower. But these two positive factors, the first two factors, this positive factor, and this is also a positive factor, but this is a negative factor. But this negative factor is more than offset by these two positive factors. Therefore, Alphabet's ROE is higher, and in fact more stable also compared to the ROE of Yahoo. So generally speaking, we can say that Alphabet is better off than Yahoo in terms of performance for shareholder return. Shareholder return, you find that Alphabet is better than Yahoo over the past 3 years. That's our conclusion. Right, so we move on to the next slide. Now this is an extended DuPont chart. Let me just bring it down so that we can view the whole chart. So this is an expanded DuPont chart. So you can see this return on equity is actually a product of two factors or two components. The first one is this return on asset and equity multiplier. But return on asset is also a product of two components. One is profit margin, the other is total asset turnover. So therefore we can say that return on equity is a product of three factors. One is profit margin, the other is total asset turnover, the other is equity multiplier. So that is the DuPont identity. These three factors will determine the return on equity. Alright, now profit margin you take from the income statement. These are the boxes in blue. These are all from the income statement. The grey boxes are all from the balance sheet. So you can break this down to the individual values. So sales, these are not all in sale, it's not from the balance sheet, it's from the income statement. But these grey ones determine the total asset turnover. So you have total assets divided sales divided by total assets, but then these total assets can be broken down into fixed assets, current assets. From current assets you have cash. Under current assets you also have receivables and inventory. So this is a breakdown. Likewise here, net income, you have sales minus total cost, but this total cost can be broken down into the various components of cost. For example, cost of goods sold, then R&D expenses, then you have selling and administrative expenses, interest, and also taxes. All these make up the total cost. When you deduct this from your sales, you get net income. Alright, so this chart shows you how the original values of these items, both income statement items and balance sheet items, are used to derive these three factors. One is the profit margin, the second is total asset turnover, and the third is equity multiplier. And these three components will determine the return on equity. Is that okay? I hope this is fine. So we move on to the next slide. Let me just bring this up slightly. Yeah. Now we move on to the last part. Okay? We look at some of the uses. Okay, we have finished the fourth key component in this chapter. Now we move on to the last part, the remaining part. Now this last part looks at the uses of these financial statements, okay, and also the limitations of these uses. Yeah. So this can be used for internal use. Okay, internal means used by the managers, okay, within the company. External users, okay, will be used by external users. Yeah. For example, creditors, suppliers, customers, stockholders or investors. Yeah, so all these external users. And internal users, managers will use it for performance evaluation. They want to look at different units, competing for the same resources. So they want to see which unit in the company has performed better. Then they can use this financial statement analysis. Yeah. And this can also be used for planning for the future, to estimate future cash flows. And we will have this planning in the next chapter. Chapter 4, we'll be looking at planning, using ratios, or use percentage of sales method. But this planning is not to estimate the future cash flows, but actually to estimate the future financing needs of the company. But this financing need will also depend on the an estimate of cash flows, as you will see in the next chapter. So these are the uses. Now, ratios, these are some caution when you're using the ratio analysis. First, ratios are not helpful by themselves. They need to be compared to something. So if you just look at one ratio, or even a set of ratios, very few will tell you whether the company is in a good position or a bad position. So you have to look at ratios together, and you have to compare this with either the previous ratio, previous year, or you have to compare with a competitor's, another company's ratio, to see the situation or the position or the performance of the company. So we cannot judge the performance or the position of the company, okay, by just looking at the ratio. You need to compare ratios in order to infer about the position or the performance. So in order to do that, you can use time series analysis or trend analysis. That means you compare the performance or the position of the company in a previous year, or previous period. Okay, or you can do peer group analysis, where you compare the performance or position of the company against another company. So for the project paper, okay, you can do both, because you have time series. Individually, you can do time series, meaning you compare the performance of or position of the company compared to the previous year, previous years. So you have the data for 5 years, so you can compare the performance over 5 years. Okay, and you can also do the peer group analysis, because you work as a group, in a team of 5 students. Each student will be given one company. Therefore, you can compare with the other company's positions and performances. So that's what you're going to do in the project. Alright, so we look at the potential problems in using ratios. Okay, the first one, there is no underlying theory, so there is no way to know which ratios are the most relevant. So we have seen so many ratios. Not all ratios are equally important. Okay, some may be more important, some may be less important. But there is no theory that says which is more important. Some ratios are similar. They measure the same thing, as we have seen earlier. Okay, so therefore they don't give you a comprehensive view, okay, unless you look at a large set of ratios. So you cannot just pick a few ratios. You need a comprehensive set of ratios. So that is because there's no underlying theory. We cannot say one is more important than the other. We need to look at many ratios together. Right. The second problem is that benchmarking is difficult for a diversified firm. Okay, for example, if a company has various types of business, diversified means a company has various types of business. They're not focused on only one business. Then it's very difficult to say which is the benchmark. So some businesses may have a high ratio or they require a higher ratio, and some businesses require a low ratio. Yeah? But when you have a diversified firm that has all these businesses, then you have somewhere in the middle. Yeah? Therefore, it's difficult to benchmark. Yeah? So, especially for a diversified company. If it's a focused company dealing with only one business or one type of business, yeah, then it will be easier to benchmark. Okay, many companies in Malaysia, yeah, they are quite diversified, yeah, meaning they venture into various types of businesses. Yeah? Therefore, it's difficult to benchmark ratios for them. Yeah? Benchmark here means setting a target that the ratio needs to meet or needs to achieve. Alright, then the third problem is that due to globalization and international competition, yeah, makes comparison more difficult because of differences in accounting regulation. Different countries use different accounting regulation. Yeah? So it is quite difficult to compare, let's say, a company in Malaysia and a company in Singapore. Yeah? What more, if a company in UK, yeah? Different operating environment and different accounting regulation, yeah, applies. Yeah? Especially if you are in the US and you compare with a company in Malaysia, for example. Yeah? Alright, so that's another problem. Then varying accounting procedures. Yeah? So, for example, within the same accounting regulation, you may have different, yeah, you may adopt a different procedure. For example, yeah, FIFO is first in, first out. Yeah, this is a system used to assess inventory. Okay, and this one LIFO is last in, first out. Yeah, so the firm, yeah, may have some leeway in choosing between FIFO and LIFO. So if they use FIFO and another competitor uses LIFO, so it may reflect differently, yeah, in terms of their performance, even though the performance is the same. Okay, so therefore, different accounting procedures can also skew, yeah, or change the ratios. Okay, and this may not truly reflect the performance, yeah, the comparative performance of the two companies. Yeah. So if you want to compare, really, the accounting procedures need to also be the same. Yeah? Then only you can compare effectively. Yeah. Then the other reason is that different companies will have different fiscal years. Yeah? For example, especially in an industry where it is seasonal. Yeah. So let's say a company's financial year, fiscal means financial. Yeah. Financial year ends at the end of the calendar year. For example, 31st of December. Another company's financial year ends in the middle of the calendar year, for example, 31st of July, for example. Yeah? So you cannot compare these two companies because they have their fiscal year end at different times. Okay, so therefore it's not an effective comparison. Yeah, especially when it is a seasonal, yeah, industry. Yeah, for example, let's say sales in the middle of the year is higher than sales at the end of the year in that particular industry. Then companies that end at different, yeah, meaning having different fiscal year ends, will have different performances. Yeah, but that does not mean that one company is better than the other. Yeah, not necessarily. Yeah. Alright. The other is that there may be some extraordinary events for that particular year. Yeah, and these extraordinary events can skew or can change the ratios. Yeah, and that does not reflect the long-term, yeah, sustainable performance or position of the company. Yeah? Therefore, you need to be careful about these extraordinary events. Yeah? So you should discount these extraordinary events when you do the analysis. Now, in interpreting the ratios, yeah, you have to, I recap, yeah, these are some additional notes. You should not jump to a conclusion by looking at just one ratio. Yeah? Right? So that's an important point. Yeah? I've mentioned this earlier. So, and do not use ratios to judge. Yeah, you cannot say good or bad. Judge. Yeah, judge as a general rule. Yeah, you cannot say this company is good and that company is bad. You must be more specific. Yeah, for example, good in what? Maybe in managing liquidity, in managing cost, okay, or in managing debt. Yeah, things like that. Yeah? You have to be more specific. You cannot say good overall. Yeah. So in order to do that, you have to look at a large group of ratios. Yeah? So on balance, you find that there's more good aspects than bad